The Federal Reserve has finally begun to unleash their secret weapon on the markets. The reverse repo facility has finally begun to drain. The Fed has been keeping this weapon in their back pocket for a few years now, and the time has finally come, and we're about to see up to $2 trillion be released on the market. So what is this reverse repo facility and why does it matter? The reverse repo facility is one of two tools that the Federal Reserve uses in the repo market. In this case, repo stands for repurchase. Very simply, in the repo market, the Federal Reserve will intervene either to keep rates low where they want them or to keep rates high where they want them. The Fed has both the standing repo facility and the reverse repo facility. If the Federal Reserve wants to keep rates lower than they normally would be, they will use the standing repo facility. But if the Federal Reserve wants to keep rates higher than they would be normally, they will use the reverse repo facility. Now, up until the Federal Reserve started tightening in order to deal with inflation, you might think that the only thing the Fed cared about was keeping interest rates lower than they would be otherwise. However, that's not exactly the case. They did want to make sure they kept a lid on interest rates, but they also needed to keep a floor underneath interest rates. They wanted a very small gap in which interest rates did not leave. And so starting in March of 2021, they started to use their reverse repo facility to keep a floor underneath interest rates. This is even though they were also at the same time trying to keep a lid on interest rates. Very simply, they didn't want interest rates to go negative, but they also didn't want interest rates to get too expensive. So the reverse repo facility is the tool that the Fed uses to put a floor underneath interest rates, or I should say it's one of the tools. They do this simply by paying an interest rate on any cash that comes in to the reverse repo facility. Over the course of the last couple of years, as they raised interest rates on the reverse repo facility usage, we saw during the same time trillions of dollars flood in. And because the Federal Reserve has the monopoly on money creation, essentially this is the only place to get a risk-free return in the entire market. So financial institutions, things like money market funds, they'll park their cash in the reverse repo facility and they'll get paid whatever the interest rate, currently 5.05%. And ever since June of 2021, the interest rate being paid is always 0.05% higher than the bottom end of the target range of the federal funds rate. Currently, that end of the range is 5%, which means the reverse repo facility is currently 5.05%. This also highlights that in a fiat monetary system, savers are lenders. Because if you put your cash in a bank, it gets loaned out as a mortgage or to the government. You put your cash in a money market fund, well, it gets lent out to the Federal Reserve. So unless you have physical cash underneath your mattress at home or buried outside in your backyard, if you have dollars, you are lending them out. But first, a word from today's sponsor, Vaulted Silver. Did you know that most of the time silver is more expensive than gold? Obviously, I don't mean per ounce, but most of the time when you're buying silver, you're paying 20%, 30%, even up to 50% in premiums, markups, and commissions. But Vaulted Silver is changing the game. Vaulted Silver has managed to cut out 70% of the traditional supply chain for silver. This eliminates almost all premiums for buying physical silver, and it also increases security. With Vaulted Silver, investors always own designated serial numbered bars or specific sections of segregated bars. This is a different model than most services that offer pooled metal. Vaulted Silver investors can even move their holdings into smaller coins or bars at any time to take physical delivery. This groundbreaking pricing paired with their rock solid asset structure is something no competitor can touch. They were able to do this because of a unique partnership with HSBC Bank. HSBC Bank is one of the 4 large institutions that is the core of the London bullion market, which is the largest and most liquid in the world. And the only reason Vaulted Silver was even able to form this relationship is because of some other projects the company has going on. Because usually HSBC vaulting services are reserved for for the massive players like GLD and even like central banks. Clearly, vaulted silver is being launched on the back of an enormous amount of time, effort, and money, all put into making the top of the line, world-class silver storage product for you. As always, the Vaulted website and app are insanely easy to use and allow you to get started in literally just a couple of minutes. And the best part is they gave me a discount link to offer you that actually gives you free storage on your silver through the end of this year. So if you want to take advantage of that crazy deal, sign up for Vaulted Silver using the link in the description today. So it's clear that $2 trillion flooded into the reverse repo facility over the course of the last couple of years, but where did that money come from? Well, basically, it was the money the US government borrowed to deal with all of the spending that was related to COVID. And that borrowing was financed by the Federal Reserve. So track with me here. The federal government says, hey, we need to spend $3 trillion in 2020. Round numbers here. So they say, we want to borrow it, but we know there's not $3 trillion in banks and people's savings accounts for us to borrow from. So the Federal Reserve steps in and says, hey, we'll print $3 trillion and through the financial system, we'll lend those dollars to the government. The government then says, great, thank you. We just borrowed $3 trillion. It's now in our checking account and we're going to start spending that out into other places where we think it's important. This is something that's key to understand about the banking system is that anytime the government spends money, that's going into somebody's bank account. And then every time that person or that company then spends that money, it goes into somebody else's bank account and so on and so forth. Whether you buy stocks or you buy gold or whatever you're buying, those dollars are simply moving from one person's bank account to another person's bank account. So as the federal government started to spend all of those newly printed dollars, they were going into people's bank accounts. Banks needed something to do with these dollars, and that's why the Federal Reserve opened up the reverse repo facility, started paying some interest on it to capture all those dollars so that it wouldn't flood the market and banks wouldn't have to buy things like T-bills and push interest rates negative. Because at the time, interest rates were already so low on that short-term government debt that if banks would have used that influx of deposits and then bought collateral like T-bills with it, they could have absolutely pushed interest rates negative. And so over the course of the next couple of years, the Federal Reserve continued to pay more and more into the reverse repo facility so that banks and money markets, financial institutions, would continue to put more and more cash in there. And they kept this up because eventually they needed to switch over to tightening, in which case they still needed a floor under interest rates. They just needed that floor to be higher and higher and higher. But something changed at the June FOMC meeting. They paused raising interest rates, which means now they don't need that floor on interest rates to continue to move higher. And as a result, money has already started coming out of the reverse repo facility. In fact, in just the last couple of months, the reverse repo facility has drained about $300 billion from 2.3 trillion down to 2 trillion. So now that that money is leaving the reverse repo facility, where is it going? Well, it's starting to go into short-term US treasuries. Basically, it's getting lent out to the United States government. As the United States government has to borrow more and more and more, they're going to continue to have to pay higher and higher interest rates. As they pay these higher interest rates, they become more attractive because that's a better return than what the Fed is paying in the reverse repo facility. In fact, at the last press conference after the June FOMC meeting, Jerome Powell specifically said that the Treasury General account would be rebuilt using the reverse repo facility. What does that mean? Well, this account, the government's checking account, the Treasury General account, is drained right now. This is the account that showed the big $2 trillion spike when they did all the borrowing in 2020. And as they spent that money down, it drained. Well, now the government is going to have to borrow probably over $1 trillion over the next couple of quarters. Part of that will be to rebuild their reserves back to about the $500 billion mark. And the other part of that will just be to pay for their ballooning expenses. Over the course of the next decade, it is projected that the federal debt as a percent of GDP will explode to record levels. So more debt at the same time as interest rates are higher than they've been in a very long time is not a combination for fiscal success. Basically, what this means is that the government is going to have to continue to borrow more and more in order to pay for its continued borrowing more and more. And this reverse repo facility with $2 trillion in it right now is where the next $2 trillion of government borrowing will be borrowed from, which means the federal government will be borrowing at an interest rate of at least 5.05%, because if they're borrowing or trying to borrow at a rate lower than that, well then all those dollars are going to stay in the reverse repo facility, because that's the only place that you can actually get risk-free return. So that operates as the floor. But as the government says, okay, we need to borrow more, will you lend to us at this rate? And everybody says no, they'll have to offer higher and higher and higher rates, and eventually gets to the point where money says, yes, I would like 6% more than I would like 5.05%. So those dollars will leave the reverse repo facility and go to be lent out to the government. Now, if you connect this with what I said earlier, you might be thinking, well, if that money gets lent to the government in the form of a treasury or a T-bill, the government is going to spend that money again. And when they spend that money, it goes into somebody else's bank account. So won't it wind up right back at the reverse repo facility? And the answer to that is actually, for the most part, no. We can discuss that in another video, but this should be positive for bank reserves. Now, it's worth noting that this also comes at a time when the Federal Reserve's balance sheet is declining. Now, compared to how much it ballooned in the past, it's not declining by much, but it is still declining. And the reason is because the Federal Reserve is still saying, hey, we're trying to fight inflation and we are not financing the government's expenses any longer. Because like in 2020, when the government needed to borrow $2 trillion, the Federal Reserve signed up and said, here, let us print it for you. They're not doing that right now. In fact, they're doing the opposite. They're not rolling over the debt that they have. They're actively letting some of it get paid off, which is destroying money from the system. The money supply is actually declining. Again, not by much, but it is actually declining. And so the Federal Reserve is staying consistent and saying, hey, we're fighting inflation, destroying the money supply, making some debt on net get paid off. We're reducing our balance sheet. So how does this square with them releasing $2 trillion from the reverse repo facility? Well, the answer is technically, it's not really actually them doing this. Yes, they set the interest rates, and if they want to keep that money in the reverse repo facility, they could just continue to jack the rate up that they're paying in there. But in reality, those are dollars that they already printed, that they already lent to the United States government, that the government already spent. The reverse repo facility is really like an overflow for the banking system for additional dollars so that they don't push rates negative. Without the reverse repo facility, without that overflow of dollars, they would push interest rates negative, or at least they would have in the beginning. So the Fed is using this reverse repo facility as kind of like a buffer zone, as an overflow pool for those extra dollars that the system couldn't handle without pushing interest rates negative. And now that that's no longer a concern, they're going to allow those dollars to flow back into the banking system. And so that's why this won't really have any sort of a stimulative effect like returning to quantitative easing would have. At the most, this is going to prevent liquidity issues. This will prevent the federal government from going out there and saying, hey, we need to borrow money. And then regardless of the rate they offer, nobody has any dollars to lend to them. So at least for the next $2 trillion the government borrows, that won't happen. The reverse repo facility is there in order to provide that liquidity, and it's at a pretty high interest rate. Remember, the reverse repo facility is there to provide a floor underneath interest rates. That means the lowest interest rate is much higher than it would be without the reverse repo facility there. If that weren't the case, there would be no money in there anymore. So as long as there's still money in the reverse repo facility, that means that the natural rate without that there would be lower. And so maintaining the reverse repo facility as it is and allowing that money to bleed out naturally as the government has to pay higher and higher interest rates on its borrowing means that on net, this is not a form of stimulus like QE. This is not pushing interest rates down. This is exactly the opposite, keeping interest rates high. Yes, there are winners and losers with all of these policies. And yes, keeping interest rates high, especially with something like the reverse repo facility, is massively beneficial to financial institutions. But more and more today, those rates are starting to come through for individuals, like with money market funds. You can get a little over 5% in many high yield savings savings accounts now and in money market funds. And most of that is due to the reverse repo facility. So in summary, there's $2 trillion in the reverse repo facility right now, but a couple $100 billion has already bled out of it, and that will continue here, especially as the government is forced to borrow more and more over the coming months. As they do this, they will be borrowing at higher and higher and higher rates, which means that more and more and more will come out of the reverse repo facility in order to provide that loan. These are extremely high rates because the reverse repo operates as a floor underneath interest rates. And if the natural interest rate would be higher, then the reverse repo facility would already be drained, which means that as of right now, this will not provide stimulus in terms of the monetary policy itself. Wherever the government decides to spend that money, obviously they're going to be the recipients of that, but the government will be borrowing at higher and higher rates as a result. And so liquidity is not an issue right now. There's plenty of liquidity, $2 trillion. It's just a matter of paying for that liquidity. And finally, if you're looking for the best place to learn financial literacy, where you can learn advanced investing strategies, fundamental analysis, options, hedging, portfolio allocation, getting out of debt, and more, check out my membership program at Heresy Financial University, where you get access to every single course I publish, the entire library of training content, and every single time I come out with more content, you automatically get access to it. Once you're a member, your price is locked in forever, and in the future, as I raise the price, as the library becomes larger and larger, it's only more expensive for new members, not for you once you're grandfathered in. If you're interested, check it out in the link in the description below. As always, thanks so much for watching. Have a great day.